Hey traders, this is Blake Morrow with Traders Summit, and with me today is once again Jim Welsh from Macro Tides. It must be Friday. How you doing, Jim? Good to have you.
It must be Friday. Thank you very much. I'm doing
well,
good.
welcome back from your vacation. We were really, I feel great that we had you on last Friday, and you were on holiday and you're on vacation, and you took the time to actually spend with us. So, based on that alone, if you guys and gals are watching this via YouTube, this video, make sure you give Jim a thumbs up. Make sure you subscribe to the channel so you don't miss any of his content on Fridays, because we try to be here every Friday, even through a holiday. So it's really great to have you here. Now, last week you alluded to a 20-year cycle, and we actually have the charts and the data to display what you're talking about. And that's a really, really big topic of conversation, I think, going into next year, especially with some of the things that we are dealing with inflation and, the easy money policies starting to end somewhat. So we'll talk a little bit about that here in a moment, but I want to catch up on just a couple of near-term events that have taken place over the course of the last week between the last time we talked. First and foremost, today, and it's Friday, November 19th, just for reference for people listening in a little bit late. We want to talk about the COVID lockdowns. I think in Europe, the euro is down significantly, broke back below 113 earlier today, touched a new trend low on some of the COVID. It was Austria, right, that went into lockdowns. And I think a lot of people were worried that Germany might go into lockdowns. Now, we just got a report from Bild, Germany's one of their magazines, said the German finance minister said that that's not going to happen. So the euro has recovered somewhat. But I got to ask you, for us in the United States, I think we've gotten over the idea that COVID lockdowns are going to happen here in the U.S. because, we don't. I think in the United States, we've kind of looked past that, but a lot of parts of Europe haven't, and a lot of other parts of the world haven't either. So do you think the COVID potential lockdowns that we might see, do you think it's really going to have a longer term impact on the markets? What do you say about all that?
Well, I think it'd be unrealistic, Blake, not to expect some kind of an uptick in COVID infections and cases in the United States as we go through the holiday season. Weather gets colder, more people are indoors together, and especially the holiday season brings more people together from different parts of the country and so forth. So my expectation is we are going to see an uptick in cases. And I've been talking a little bit about what's going on in Europe because they've had a very significant uptick in cases. And in some countries, they have a greater vaccination rate than we do. So again, I think this isn't going away. And so I do think it could be a factor as we go into January where COVID cases pick up. And even though the foreign minister supposedly said, no, we're not going to do any lockdown, the fact that that subject is being discussed shows that Germany is having an issue, that there is a significant spread going on. So it just reminds everybody, this thing is going to be with us, I think, for a period of time. And it's always going to be working. And I don't feel, that the vaccines, as effective as they are, they're not 100% effective. And we know that. And so that we might have to have, one or two or three boosters. I think that's something that we're going to have to come to live with.
It's interesting, Jim. I living in a state, you and I, even though we live in neighboring states here in the United States, Arizona, where I live, and in Florida and other states, we really, are the states you want to be in if you're not too worried about COVID. But you get into other states and things get a little bit more strict and constrictive, like in California, for example. But for the most part, I know a lot of people that have been vaccinated, unvaccinated. I'm not here to talk about what's right and what's wrong, but talking with people that are unvaccinated, what they'll tell you is I'm not putting that in my body, but I'm really, going to be more open to do things when there's better therapeutics, which, knowing a lot of people in the medical community personally, with half of our family are physicians and doctors, family practice, emergency ER doctors. I know that a lot of that stuff is coming, especially going into the early next year. So we might really be dealing with this a little bit longer term.
Yeah, no, I don't doubt it. Until they get a vaccine that can completely eliminate it, we are going to continue to deal with it. And there's going to be, variations that show up, and that's just going to, I think, be part of that process.
But
so,
do you think that most government, now obviously Austria might be a different animal, obviously, because they went in a lockdown, but do you think most governments probably are looking at the risk versus reward, risk to the to slowing down the economy? Versus the risk to the people. So I mean,
a year ago it was a different equation in a sense that the vaccination penetration was far lower than it is now. So the risk of, again, I think all the policies have to be geared so that in local areas, the hospital resources, medical resources aren't overwhelmed. Yeah. And so, what we needed all along was a set of rules that would change with the changing conditions. Well, as more people do get vaccinated, we're seeing that the probability of hospitalization and death does in fact go down. And I think that's, a key point going forward. But I think, until they come up with a quote unquote cure, we're going to be dealing with this
well, maybe that cure is going to end up being more therapeutics than anything, just dealing with something like we deal with pneumonia and those.
Let me give you one stat. Okay. Sure. If you go to the CDC website, they break down deaths by age groups, and the 50 and older account for 94.5% of all the deaths. So that means 49 and younger is about 5.5%. 17 and younger is 0.007%. 7 out of 100,000 young people under the age of 17. So some of those numbers are obviously skewed because, it's so weighted to the old people over 50. But again, it underscores that if you're 20 and you're healthy and you don't have any comorbidities, you're likely to probably be okay if you get infected. And I don't know if people are looking at it that way. But
it's a role. That and I hear what you're saying. I do have to point one thing out, is that one of my kids, who's an athlete, he's 14 years old. He got COVID. The rest of us managed not to get it. We kind of locked him up in his room. But here we are 3-4 months later, and he's still his sense of smell. Eggs and chicken, those types of things, they don't sit right with them, and they smell horrible. So that means it did neurological damage somehow, and it's still affecting him 4 months later. So we are still grappling with not understanding what all the long-term effects are, and that's a fact.
Absolutely.
And I know that firsthand.
Personally. Yes.
And so I think that's what scares a lot of people, and that's what it's a big worry. But forget COVID for a second. Let's talk a little bit about the dollar. The dollar peaked out this week, and we saw it hit the 50% retracement of the entire COVID lockdown move in the US. Yep. We hit 96.10. We reversed, or 96.20, somewhere up there. We pulled back. It rallied back today because of the fears that people had in Europe. But what are you thinking with the dollar? I mean, overall, you have to look at the dollar and say, hey, we have broken out, and obviously there's still a bid in the dollar. How do you feel about the dollar near term? Are you a buyer? And if you are a buyer, where are you a buyer at, and why?
Okay. Again, longer term, as we've talked, my expectation was that the dollar would make a low late May, June, and potentially over the next year rally to 100. Short term, as I noted in this past Monday's weekly technical review, that the 50% retracement of the high in March 2020 to the low in January was 96.10. I think we got up to 96.23, 96.24. The RSI is above 70. I think this is a perfect place for the dollar to take a breather, pull back. That breakout area about 94.50-ish would be a logical place for a pullback. In other words, broke out above resistance, comes back, test it before it resumes an uptrend. So that's my expectation, is that the dollar will pull back a bit in coming weeks, maybe test 94.50 before ultimately breaking out above 96 on its way to 100 sometime in 2022.
Well, that's good to know. And I think people that are long or looking to be long the dollar need to be thinking, let's buy the dollar on pullbacks if you can see it. Now I'm going to shift everybody's attention. I want to talk about what you alluded to, and you kind of teased last week, you talked about this 20-year cycle, and I'm going to share with the traders listening in. I'm going to share what you shared with me to put it up here. And let's talk a little bit about what we're viewing right now on this 20-year cycle, and tell us a little bit about it, because I think this is an important topic if the cycles do stick. You know, I was just reading a research report. I read so many of them, I forget what bank, but I believe it was Morgan Stanley, said you do not want to be long equities in 2022. And that was just the gist of it. But let's talk a little bit about your reasoning and just tell us what we're looking at here first and foremost.
Yeah. Well, basically, A is the consistency. 1903, 1921, 42, 62, 82, 2002, and obviously 20 years later gets us into 2022. So the consistency of the cycle is, I think, noteworthy. The other thing is that each of these lows were accompanied by a different fundamental reason. So it's not like, gee, the same kind of thing caused it. Different things caused it, which makes it interesting. And I think, setting the table for next year, we know Fed monetary policy is going to be a primary focus. Inflation is, for months, my take has been inflation was going to be hotter and not transitory, and that the Fed is going to have to deal with that. And I think as we go into early next year, inflation is going to probably stay above 4%. So that is one of the things that potentially could cause a correction in the S&P and in the overall market. Obviously, if we had a bad COVID outbreak sometime in the first quarter, that could cause it as well. But again, it almost doesn't matter what the reason is. This cycle is suggesting that sometime in 2022, there's going to be probably the biggest correction we've seen in quite a while. And I think that's where this comes into focus, so that I'm going to be focusing on the technical setups. I'll back up 1 second. My take last week was the S&P would rally above 47.18, and that would then maybe 47.50, 47.35, then get a pullback of 4 to 6%, and then another push in the first quarter that takes the S&P of 4,800, 4,900. Then I think the market is going to really be ready for a 10 to 15% correction. So that's the short term fixed into the bigger picture. Okay. And it's that simple.
And first of all, it makes sense, but I want to play devil's advocate, or I want to look at the other side of this, because based on what you're showing us right here, Jim, each one of those 20-year cycles has also produced not only, a sell-off, but it has produced a tradable low where if you're not involved, you can be involved in the market. So I don't think you can look at this based on what you're presenting to us today, that, hey, it's all doom and gloom. If there is a correction, that's a tradable low more than likely this year or this upcoming year. Would you agree with that?
Yeah. I do. I don't, again, major bear markets typically are associated with recessions because earnings get impacted and everything else in a big negative way. I don't anticipate that. I think we're going to get a shakeout that kind of tempers some of the bullishness that's out there. And it's really, really pretty widespread at this stage of the game. But I don't believe monetary policy is going to become so restrictive as to tip us into a recession. So yes, my take would be is you get a 10 to 15% correction. If it turns out to be more, so what? Ultimately, then I think we're going to go and exceed whatever high is made in the first part of 2022. This correction, I think, is a wave 4, put it in, Elliott wave terms, and then a rally to higher highs in the, later part of 2022. So I'm with you. I'm glad you brought that up. It's a good point, because I think people need that context that in all likelihood, there's a nice size correction coming, but the probabilities, I think, favor that after that correction, we're going to higher highs.
Well, if you think about this, Jim, with Fed Chairman Powell, if he keeps his job, or if you bring in a new Fed chairman, which, at this point we're thinking potentially Brainerd, either one of those two Fed governors are going to be accommodative to any type of substantial pullback that we see in the market. And what the market is really kind of I want to say Pavlovian behavioral like really understands is, you see a sell-off of 20, north of 20%, or I guess it would be south of 20%, but any which way you want to look at it, 25% correction in equities from the high watermark. Well, you're probably going to get some sort of Fed response. And if that's the case, we see some sort of correction. We get that easy money policy. However, you taper back on tapering, or if it ends up being a policy error where the Fed actually has to raise rates and then lower it again, whatever the case may be, at that time, that might be that low that is produced sometime into 2022. If your chart stays.
Right. Yeah. One of the things I would say is I think there's a potential, Blake, that the Fed actually increases the tapering process from 15 to 20 billion. Inflation is going to continue to run pretty hot and heavy going into next year. That would be, I think, potentially the negative trigger that, oh my goodness, the Fed's going to increase tapering and people are going to start projecting, oh my God, they're going to start raising rates sooner rather than later. It's going to be more, blah, blah, blah. So potentially, they increase the size of the taper. You get a 10 to 15% pullback, and then they're not going to do anything with rates for a period of time. So, again, I think the Fed doing something with the tapering by increasing it gets back some of their credibility, because they were completely wrong about, it being transitory. And I think the other issue that's going to be problematic is wage growth, I think, is going to continue to be pretty strong, that there's not as much slack in the labor market as the Fed thinks. And that's going to keep upward pressure on wages. But again, I don't think the Fed is going to be in the rush to, constrict monetary policy to the point that a recession really becomes a risk. I think this could be an event type of sell-off where it's 10 to 15%, less than 2 months, and then you're back on the road again to higher highs.
All right. Well, Jim, I want to thank you for presenting this information to us and your 20-year cycle. And going back to your comments about the Fed, were they wrong? Or like a lot of financial Twitter likes to use or was it just a big kabuki theater play? It's like, what was the, are they trying to paint a different picture? They're trying to pull a fast one on us, Joe and Sally Public. Anyway, Jim, I want to first ask you, if I'm a trader, I'm sitting at home and I'm like, man, I like your stuff. How do I find out more about you?
Well, go to macrotides.com, send me an email, jimwelshmacro@gmail.com, and I'll send you some information. I think, for anybody who has a short-term horizon, the Monday weekly technical review that I do focuses more, as the name implies, on the technical aspects of stocks, bonds, gold, the dollar, and other markets when it seems appropriate. So that is much more short-term oriented, whereas the monthly macro tides is, as the name implies, a bigger picture, more fundamentally based piece. So that's why I try to do both. But the technical Monday report, is by nature more short-term focused, and I think probably more suitable for those who are actual traders.
Well, I'll say as a trader myself with the Forex analytics community, that I really enjoy reading your technical reviews. It gives me another different perspective, and I urge everybody to at least try it out with you, Jim. So, Jim Welsh, thank you so much for joining us on a Friday. I love our Friday talks, and I think people at home do too. So if you are listening in, you can get to Jim by go into the description down at the bottom of this video on YouTube. Make sure you give Jim a thumbs up, subscribe to the channel, and thanks for joining us. We'll see you next Friday, Jim.
You got it, Blake. Have a great Thanksgiving in the meantime.
Oh, shoot. It is Thanksgiving. Maybe we'll see. We'll see about next Friday. Have a great one, Jim. Have a good Thanksgiving to you.
Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.